And we have Nitin Bhasin joining us. He's Head of Equity Research at Ambit to take some questions now. Nitin, good morning and thank you very much for joining us today. This is Pavitra. You know, we've already seen quite a shaky start to 2023. There has been a lot of, volatility in markets, which is played out and is reflecting in our own markets as well. How do you think it's likely to pan out, at least in the medium term? We have that huge trigger coming through in the form of the budget. And also, of course, the earnings season is underway as well. So how do you think it will play out, at least in the near term? Do you think this volatility is likely to persist?
Hi, good morning, and thanks for having me for the show. I agree with you that, how we perhaps see the next 3 months, there would be more volatility in the market. Though in the beginning of the year, when we wrote the note about how do we look at the market, we think there's a fair valuation of an 8 to 10% upside if one was to think for the year. For the next 3 months to 6 months, we're going to see one of the big changes in the Indian market, which is the domestic flows, whilst earnings have an impact on a near-term basis. But the last year, what we also saw is as the FIs were perhaps selling in the first half, the domestics throughout the year, especially the flows, held strong. And what we are noticing now is beginning of some sort of a softness in the flows from the domestic market, especially because either the last 12-month returns of the market or secondly, the rising interest rates in the deposits perhaps impacting. So as we go through this earnings season and as we go through this shift in the DI flows, especially from the savers, that would create volatility, at least for the next 3 months. And add to it what's happening into the US, the entire talk about recession perhaps in the US or the other developed market. So volatility will remain high.
But I guess volatile times are the best times when you get opportunities, right? Especially in the stocks that you like, and the best time to make money. So I wanted to ask you, Nitin, a little bit about the buzzing stocks. I mean, Persistent Systems is really gaining now. And if you look at the price action of, if you pull up, say, 1 year chart, it's still way off its 52-week high. The 52-week high of Persistent Systems was almost 5,000. Do you see more upsides now here for some of these mid-cap IT names post their earnings?
So about 1 year back, our point of view was the IT sector is not the place to be in. And we were underweight, advising investors underweight for IT, let's say about 1 year back. But for the last month or so, given the relative underperformance of the index, especially the IT index, to the overall market, our call has been that investors should start adding the IT sector with a little bit more towards the large cap names than the mid cap names. Mid caps as a space overall, we're pretty much not so positive for the next 6 months to 9 months. So IT has been one of the sectors that we've said that we should be adding more within that. And why so? Because A, the relative underperformance, and B, perhaps the earnings downgrades have stopped now for the last quarter or so. You saw the September quarter numbers, you're seeing this particular quarter numbers, whatever has been come out, the numbers are holding up, no more downgrades right now. And I think a number of domestic investors have moved from under ownership to, let's say, equal ownership. So hence, and the relative valuation discount premiums have also off a lot. So hence, I would say IT is a place to be in, rather than specifically talking about a particular stock.
Nitin, can you talk about your call to reduce banks to a moderate overweight? Because the earnings so far have been resilient. Is it just the expensive valuation, the recent run-up, which makes you a bit cautious? Or are you sensing that come, say, 1 year down the line, 6 months down the line, the earnings could start getting a little more compressed compared to what consensus is expecting?
Sure. So 1 year back, at that point in time, the relative underperformance of the sector to the overall Nifty was pretty much very high. And at such levels, we've seen that the banking sector lands up giving very good returns over the next 6 months to 12 months. Today, relatively, the underperformance, no, it has actually materially outperformed the market. So you are carrying a baggage of a good performance, number one. The valuation discounts have actually converged to the overall market. But more importantly, what we've seen is the NIMs of the top 11 or 12 banks posted very strong numbers, close to about 3.5% in the 1H FY23. We think that 2H FY23, you'll see a repeat of that. But as we go into the next year, the cost of funds will start having some sort of a bearing on the overall NIM margins of the entire sector. So perhaps that is the reason that we see that whilst today may not be the reason to go equal weight or underweight, one should remain slightly overweight, but mostly in the banks, and that too in the large banks, including one or two of the leading PSUs. So it's basically about maintenance of earnings. But next year, the NIMs could come under pressure, mainly because of the cost of funds. Hence, we're reducing it from a massive overweight to a moderate overweight.
All right, got it. That is on the banking space. Nitin, you were mentioning, the China reopening that is playing out right now. Do you think in that light, the metals pack is, still good to get into and good to put some fresh money into? These stocks have been rallying hard. But, this kind of information is so closely hinged on what's happening in China. Even the OMCs, pretty much all of the commodity plays move like that, right? So do you think that this is still a good time to be getting into these? And if yes, then what within the metals pack would you look at?
Within the metal pack, what we've added to our portfolio is a Tata Steel or a Hindalco. These are the two names that we like from the metals pack, large names right now. I think it is one of the plays on the China opening up trade. But also remember, they've gone through a lot of price correction in the last 3 months to 6 months. You are also seeing a massive differential between the overall contribution from the metal sector to the profits of the market versus the market cap that these stocks enjoy. And remember, these are actually operating at one of the lowest debt equities ever, closer to half right now as an index. So you've got a good balance sheet support. You've got an opening up from China. And more importantly, the stocks are actually giving you not a very expensive valuation to enter into. So hence, metals is one of the sectors where we are indicating between these two names, whether it's Tata Steel or Hindalco, to be in.
Okay. I wanted your thoughts also on how to approach the real estate names, because, there was a very interesting note that Motilal Oswal put out this morning where they spoke about how the residential sales are now at a 9-year high. And there are so many of these companies, right? Whether it's Lodha, Prestige, Brigade, they have a slew of new launches across most metros, whether it's Mumbai, Bangalore. Wanted to understand, is there any upside from a stock perspective, and which are the pockets that you'd like here?
We continue to, cover a few names in the real estate space, and our entire, view on the sector has been, it's not the affordable housing, it's basically the premium housing property developers, which are the ones to be in, whether it's an Oberoi or whether it's, let's say, a Brigade. These are the kind of companies that we like from the particular sector without giving any specific ideas. What we see is there is a massive change in India happening in terms of the age of the home loan borrowers or the home buyers. We're becoming more and more younger. So the companies which are actually a good play on younger borrowers, younger buyers of housing, perhaps those. And these are perhaps centered more around the cities which generate a lot more employment. Let's say a Bangalore market, pockets of the outskirts of the main market of, let's say, a Delhi or a Mumbai. Not so much. Perhaps the growth in the volumes will come from in the next 1 or 2 years from very heavily priced, high, large products or large flats. So those are the kind of companies one should be looking at. But at the same point in time, I would also like to add over here is the next 1 year may not be one of the best times for multiple mid-cap sectors. And, real estate is a very big mid-cap sector or a small-cap sector. When we are giving a fair valuation to the index or giving particular recommendations of sector calls, in the asset cohort size, we are also indicating that mid caps or small caps, those small caps have gone through a price correction in the last 1 year, is not the place to be in. One should be more overweight for institutional clients into the large cap names rather than the mid cap names.
Nitin, pleasure having you with us on the channel. Thank you very much for joining in. By the way, the Nifty's once again dipped into the red, down 35.